Futures point to a higher open on declining borrowing costs at an auction of Italian bonds, which eased concerns on the European debt crisis. Asian markets finished lower as Japanese data showed that the country's industrial output fell and deflation deepened. In corporate news, Bank of America considers more asset sales to raise capital, according to a report from the Wall Street Journal. I'm Jill Malandrino, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with The Street.
And I'm Brian Sozzi, a real money contributor with The Street.
And we bring a very special edition of the morning call. Both Scott and Brian are colleagues and contributors on The Street's Real Money Pro. So not only we've had Stephanie Link from Actions Alerts Plus on here, now we're bringing you a different view of the markets with Scott and Brian. So yesterday, guys, we finished really flat. It's light volume as expected for this time of year, although it's not time to fall asleep at the wheel yet, as we have a lot of economic data in front of us tomorrow and that all-important Italian bond auction.
Yeah, so I would say yesterday the market took it in stride. We had a 4-day methodical move that started last Tuesday. And even though the indices were flat, you had some key stocks that continued to break out. You had those strong stocks that were in on Santa's list continuing to make some progress. So even though the indices didn't do much, you had some stocks working. So it was a very sector-specific or strategy-specific trade going into what we saw yesterday and probably what will be the rest of this week.
So Brian, from a fundamental perspective, what are you looking at the next day or two as we round out the end of the year?
I'm a little cautious going into the end of the week. I see low volume. Volume is about 50 to 55% below average for this time of the year. I come back to my trading desk for my holiday yesterday, and I started to see some more of the defensive names outperform. You're looking at Walmart near a 52-week high, Family Dollar, Dollar Tree, and certainly looking at the Italian debt auctions the next 2 days. I think there's reason to take some off the table here.
Okay, well, at this point, if we take a quick look at the S&P, you'll see on the chart that a lot of these things are lining up. With the S&P yesterday, you did have an inside day, but look at this 4-day move that we had. This was last Tuesday. This is when the market ignited out of this descending channel. Then you had the Oracle, disappointing news by the pull-in, and then 3-day follow-through. And if you look on even more of a macro sense, look at the low. This was your October low. Then you had your November low, a higher low. Then your December low, another higher low. So I think as long as we could stay above the 200-day moving average, which is about 1259, and go a little sideways, I do think that when volume does come back and some of these money managers do come back with new inflows in January, we could take out this 1292 level in the first few weeks of January. But with what you said, Brian, as far as some of the defensive names, some of the consumer staples names, that's why I think traders are all frustrated, because we like when technology takes off. We like when stocks are moving fast, and the consumer staples don't move that fast, but they're all working. And if you take a quick look at the chart of the Dow, you will see that it's full of them, right? Full of these. And look where we are in the Dow. The Dow is actually above that October high. So it's showing you that they're leading the way, which isn't necessarily sexy, but I think it's fine.
So for 2011, the three sectors that led the way were healthcare, the utilities, and consumer staples. The nice healthy dividend plays are relatively safe in this type of market. What is your thoughts for 2012 with the staples? Do you think they continue this momentum?
I think it's the ultimate contrarian move, what we're seeing here today. You have oil back over $100 a barrel. You're seeing, I think, a little more risk regarding what's going on in Europe, certainly with the Italian debt auctions too. So to see these names outperforming, I'm going to take the contrarian card. Maybe giving some exposure within small caps within a Russell ETF that's, I think, has gotten underappreciated here. If I had to play this boring space, I would favor Procter & Gamble here. I like what Target and Walmart are doing not only opening stores, devoting more shelf space to brand name goods.
What are we seeing on the VDC, which is a consumer staples ETF? What's the charts telling you?
On the VDC, Victor David Charlie, you're seeing relative strength. You're seeing an ETF that's above all the key moving averages. It looks like it could break out to new highs. If you look at the monthly on this, because it's a new ETF that was just established in 2005, it's almost at highs. So I think you can get some follow through here. As far as some of the names that you mentioned, you have a stock like Procter & Gamble on the weekly chart. Looks like it's going to continue to go. Daily chart, it's a little bit extended, so to speak. PG, did you mention that one also? Procter & Gamble coming up above 65, on its way. So you're saying take some money off the table with this and rotate into the Russell?
I think that would be it. If I had to choose, I would continue to ride the wave in Procter & Gamble. But broadly speaking, I'm not necessarily looking to get into a Kraft. I'm not looking to get into a Kimberly-Clark here, just because these are global multinationals. There are risks, fundamental risks associated with that. At this point, it's not where I want to be. I want maybe a little more exposure to the Russell ETF because nobody appreciates it right now.
And we'll take a look at more stocks as we get into the longer version of the morning call. In the trenches, we're going to look at the energy names, which tends to have a little bit more volatility in the space because of the underlying, which is oil. As Brian mentioned, we're over $100 this morning.
Yeah, and a lot of these stocks have had major moves. You're talking about XOM, we've outlined it so many times. Chevron, one of your favorites, came right back even after the headlines of this spill. So I feel like with that, there's a little bit more sex and sizzle in that arena and a little bit more bang for the buck. So traders would much rather be playing the XLE, the OAHs, for breakouts versus the consumer staples. But I think as long as the consumer staples stay strong, a lot of Americans have that in their 401ks. Maybe it adds to market sentiment on the positive side, and then we get some, higher growth names starting to go, and then you mix it all up, and it's a first decent quarter in 2012.
Okay, and again, in the longer version of the morning call, we're going to take a look at more individual names in the consumer staple space and the energy space. Don't forget to catch Scott at the end of the day as he wraps up the charts for us.